$2 billion under management. That's a lot of money.
But I hate losing money and I hate wasting money. So I've grown up with that mindset as a kid, and I've carried that mindset on throughout my entire life and everything I do. You shouldn't be wasting money. You shouldn't be cutting corners. A lot of what I did was learning and observing and learning from what other people did that didn't work, and then what other people did that did work. So one of the things I learned in 1994 from investing in funds like Julian Robertson's fund, Chris Minodi's fund, you see what happens if you get too big in a particular sector, a particular region, or a particular stock. Liquidity kills you on the way down.
My name is Marcus de Maria, and this is the Success Series. Today my guest is Derek Stewart, founder and CEO of PaySme. PaySme is an innovative app that is transforming the future of mobile payments, commerce and enterprise for the small business owner. Coming from humble beginnings in Scotland, but now based out of London, Derek's career has an extraordinary 35 years within the investing and finance industry, with only 1 year of negative investing in 2008. Being the former CEO and founder of Bank of New York Mellon hedge fund business, Derek took this company from an idea with zero capital to $2 billion in less than 10 years. To say this man is an expert in investing and finance would be an understatement. And today, we have invited him in to ask all about his lengthy career in the world of money and what it takes to become wealthy. Everybody, Mr. Derek Stewart.
Thank you.
Derek, thank you so much for your time.
Okay.
Real pleasure. So I've got some questions here for you just to get started. Let's start at the beginning. You know, Scotland to finance tycoon in London. Can you share, how did this all start?
Sure. So I was 16, living in a place called Clydebank in Glasgow. The shipbuilding industry was closing. The largest sewing machine factory was closing. It was difficult to get a job. So I happened to be in London visiting relatives, opened up the Evening Standard, saw a job advert in the paper. Have you got 6 O-levels? I had. Do you want to do merchant banking? I wasn't quite sure what it was, but sounded interesting. And do you want to earn at the time £5,000 a year, which was double the income you would have earned in Clydebank, even if you'd gone to university and become a graduate. So I went for an interview. I bought a jacket and trousers, had an interview, got offered the job on a Thursday, moved back to Glasgow on a Friday, packed up, went out with my friends and moved to London on Sunday and started work on Monday. The company I joined is now called Invesco.
Oh, wow. Okay. Very huge company.
So effectively, I didn't really have a huge choice. It just seems so much more exciting to be working and earning and be in London than in a small town where it was in sort of industrial decline.
For sure. So tell us, because people here probably don't know, what is a merchant bank?
So the company that previously owned Invesco was Montague Investment Management. Sammy Montague was a merchant bank that provided a whole range of services that included anything from banking to financing to trade finance to investment. So it was really a range of services. And I think today the traditional merchant bank probably doesn't exist in the same format as it did in 1984.
Mm-hmm. Okay, so $2 billion under management. That's a lot of money. How does it even feel to be managing $2 billion?
Well, I guess you have to understand how we got to $2 billion. So we approached BNY Mellon, at the time was just Mellon Bank, with an idea for a way of managing hedge funds and hedge fund strategies that we felt would be institutional.
Just remind us, what is a hedge fund?
I used to get asked that question so many times. I've been out of the industry for a while. So whereas if you invest in a traditional long-only fund, it tends to track or follow the market.
Right.
The whole concept of what we determined as a hedge fund and the way we managed it was about picking a stock or an industry and picking a stock long that you thought was going to do well, shorting a stock that you thought would do poorly within the same industry. So what you're effectively doing is taking out traditional directional stock market risk, traditional sector risk. So you're not betting on the market or the sector.
Right.
You're really betting on that company A is better than company B, so let's bet on the management and the strategy and hedge out our market risk.
I was going to say, so that's classic.
So we were a classic hedge fund.
Yeah.
And a lot of the strategies that are determined or defined as hedge fund strategies, we didn't get involved because they were directional or they were volatile and they were non-hedged. We were what I'd call a classic hedge fund.
Okay, and so yeah, you're right. You know, so how did you do that from just an idea to having 2 billion? Is there like a step-by-step system, or how did you manage that?
So when I first joined hedge funds in 1994, I worked for 2 companies between 94 and 2000, and in that period there were some significant market shocks. So there was the 94 macro crisis, there was I think it was the 97 crisis, there was the Asian crisis. So it seemed to be in that period, it was quite a short time, there was a crisis pretty much every year or every second year. Okay. So a lot of what I did was learning and observing and learning from what other people did that didn't work, and then what other people did that did work, and I kind of developed my own methodology really of investing over a period, I'd say, of 7 or 8 years. So in that period from 94 to 2000, we were profitable every year, but I'd say I was still learning. And at that time, you had really no internet, so it was pre-internet.
Wow.
Pre-research databases. So everything you did, you had to kind of figure it out, go and find it for yourself, and figure out how you're going to make money. So it was a very different world to today when everything's moving in milliseconds.
Did you think it was easier then, more difficult then, or the same because you didn't have the internet?
It was easier because the inefficiencies were bigger and lasted longer, because you didn't have technology to close the inefficiencies.
And you could take advantage of that.
Yeah, so investment cycles like arbitrage returns were quite often in the 15 to 20% range.
Wow.
When we were starting out. And by the time almost 20 years later, we were much better. The arbitrage was much smaller because of technology and liquidity. Yeah. So when hedge funds were unknown, unheard of, it was a lot easier in hindsight. It never seems easy at the time. No. So margins were bigger, things moved slowly. So a cycle might be, a lot of the stuff we did in the late 80s was merger arbitrage. You could set those trades up and you could just make money every month for 18 months.
What's a merger arbitrage?
So merger arbitrage is when one company is buying another company. Before that merger is consummated, there are a number of barriers to overcome: shareholder votes, regulatory approval, market conditions. So these 2 companies today are different, and at some point in the coming months they will converge and become one, but in between there are a number of hurdles and barriers. That presents what we call risk arbitrage or a mispricing. So as they move closer with more certainty, become one company, that arbitrage or risk premium gets smaller and smaller, but at the start there are a number of barriers. So you effectively go long one company and short the other by hedging them out.
Fantastic. Okay, so the 2 billion again. So did you start out saying we're going to go for 2 billion, or because that's a big number?
We had no set numbers. I think prior to that, in the prior 7 or 8 years, the maximum I'd managed was $250 million. In various portfolios. And again, just to clarify, we were a fund of hedge funds, so we were picking individual strategies, individual funds, and packaging them together. So for example, if you were a high net worth investor, it's going to be difficult for you to pick the 15 best funds in the world all at the same time. Yeah. So effectively, we would build a portfolio that might give you a combination of diversification by strategy, by region, by manager, but we would pick the strategies and we would determine the asset allocation. So the most we'd ever run before was about 250 million. So we never really set out with a target number. And the other thing about an asset management, in all asset management, the killer is if you take on too much capital and you can no longer deploy it. So if you look at most of the successful hedge fund managers like a George Soros or a Julian Robertson, they were very successful generating 30% type annualized returns in the early days when they were largely not that well known, hedge funds weren't well known, and their capital base was quite small. What happens with most fund managers, and we saw it quite clearly with Neil Woodford, is when you get carried away with your success and you think you're a genius, and I'm not saying that specifically about a Neil Woodford, but there comes a point when you're working at Invesco, you have constraints. When you leave and you're out on your own, you have no constraints. When you're unconstrained, the tendency is, let's take on more and more assets because I can collect the management fee, but then it affects your ability to focus on the smaller, let's say, less liquid stocks that you used to be able to trade in and out of when you were unknown. Now you're 10% of the company's float. Or if you buy or sell a stock, you move the market. So one of the things I learned in 1994 from investing in funds like Julian Robertson's fund, Chris Minodi's fund, you see what happens if you get too big in a particular sector, a particular region, or a particular stock. Liquidity kills you on the way down. So the one thing I'd say about managing money, you've got to make sure that the assets you're managing are appropriate for liquidity at the time. Liquidity will expand and it will contract, but you've got to be managing it so that you understand what your exit is when the time comes.
And how did it feel managing 2 billion?
I never really thought about it. We applied the same discipline on day one when we started.
Okay.
We said to our customers, we're going to invest in 6 strategies across the event-driven relative value spectrum. We're going to focus on a maximum of 20 managers at any one time in the portfolio. There'll never be 21. If we're putting 21 in, someone has to go. So you create that discipline of not just ending up with 30 funds, 40 funds, 50 funds. And we will only invest in funds where we know the largest long-short positions, sector exposure, industry exposure, because we need to know how they make money. If we can't understand how they make money every month, then you may as well give your money to someone else. So those parameters that we started with in day one, we stuck with those up to year 10. So we never really thought about the size or the pool of assets. And there were periods where no one was interested in anything we had to say. In the first 3 years, we couldn't really raise any money because we were doing something very different to the rest of the market.
So how did you get past that?
So in fund management, when you hit 3 years numbers, so I had a 7-year track record previously.
Okay, which was
pretty good in long and hedge funds at that time. It's not necessarily transportable. People want to see you do it within your new organisation or your new team or your new sector focus.
So you had to have a new track record.
So we basically built a new track record. And in the first 3 years, it was really difficult convincing people, not only because it was a new track record, but secondly, the way we invested was very different to the entire hedge fund industry. So if you have 10 people coming in explaining to you, invest in my fund, and 9 of them are doing it one way, and we're the outlier who's doing it another way, and it's never been done this way before, people don't believe you. So they like it, they find it interesting, but they're not ready to trust you with their money. So it took 3 years of building a track record. When people saw the numbers, we had one of the best track records in the world. Then the money started coming in, but it was coming in too fast, so we had to stop it coming in.
First too slow, then too fast.
So
did you ever think about quitting in those 3 years?
No, because I always have strong belief in what I'm doing. There's always a rationale, a foundation underpinning what I'm trying to do. There's always a why. Why am I doing it? So but you have to test yourself every day. In investing, every day is a different day. When you start today, you can't rest on your returns yesterday or the year before. Every day is a new day. And one of the questions that we would teach some of our team, we hired 4 graduates, and those 4 graduates we trained, and they stayed with us for 10 years. So we started with 2 people, hired 4 graduates, with the same 6 people 10 years later. We never hired anyone else. One of the disciplines is, if you were sitting down looking at that stock, that fund, or that investment opportunity today, and you were looking at it clean, would you still have bought it yesterday?
And if the answer is yes, you keep it?
If the answer is yes, you keep it, and you keep tracking, you keep monitoring. And if the answer is no, you've got to ask a question, should you just sell it then? Okay. If the rationale for being there in the first place has changed, not usually within a day, normally it takes longer, but if the rationale for investing has now changed, you have to ask yourself, should I still be investing in that position? If I was deciding today based on that information, would I make the same decision again today? And ask yourself that every day. And if you ask yourself that every day, you will keep getting better at what you do.
I think that's a real golden nugget. Are there any other things that you like from the inside that you can tell us? Like that was a real...
I think so. I'm a massive fan of Warren Buffett. Okay. And anyone who follows Warren Buffett is keep it simple, invest in what you know and understand. If you don't understand it, don't invest in it until you've gone and found out more about it, until you do understand it. So I try to keep everything really simple. I think investing is not that complicated if you stick to what you know and you maintain the discipline. So one of the things we became known as in terms of BNY Mellon, we were always very good sellers. So while people were still piling into a fund based on the recent track record, we were often the early ones in, but the first ones out, because what would happen is those managers would get greedy. They would keep taking more assets than they said they could manage a year ago, 2 years ago, 3 years ago, and they would lose their discipline. And that for us is a reason to exit. So often we would go in to meet a manager, they've had a great track record, they're very excited, and we're saying, great, your assets have gone from 1 billion to 2 billion. When are you going to return capital to investors and scale back to your original size? And if the answer is, no, we're taking on more capital, then we would sell when we get out of the office. So it's maintaining that discipline and sticking to that discipline and learning every day. You know, if you're lazy, you won't be a good investor. You have to be very disciplined, you have to be proactive, you have to be challenging yourself, and you have to be looking for information all the time.
We teach at Investment Mastery that mindset is very important. How important do you think mindset is?
Well, mindset's critical, but then mindset can be made up of many different factors. So I would liken my mindset to a couple of things. I grew up in humble beginnings in Clydebank. I was working as an 8-year-old kid, selling this, selling that, whether it be fruit and veg, dry cleaning. So I've always been earning money since I was a young kid, because we never really had much in terms of financial backing as a family. So if I wanted something, I had to help contribute and save up to achieve that. And I know how hard that was, and also for my family. So not losing money is very important. Also being Scottish, we have a reputation of being quite tight with money. So I hate losing money, and I hate wasting money. So I've grown up with that mindset as a kid, and I've carried that mindset on throughout my entire life. And everything I do, you shouldn't be wasting money, you shouldn't be cutting corners. So that's stuck with me, but I guess that goes back to my beginnings in Clydebank when I was growing up as a lad.
So do you think that in terms of building wealth, for anybody listening now, what kind of mindset do they need to be focusing on for the people listening?
Everyone will be different, right? There's many ways to make money. So the way that we've done it happens to be a style and a discipline we've developed. Doesn't mean that, so I'm not a trader, I'm more of a long-term investor.
Yeah.
I've also excluded things like commodities, currencies, and crypto, because it's just not my area of expertise. It's extremely volatile, and I like stuff that's not volatile. I like things that are predictable, long-term, and relatively stable.
Especially when you're investing other people's money.
Yeah. So we were known in hedge funds as the guys that never lose money until, unfortunately, we did in 2008. But our discipline was about first not losing money, and actually it was about accumulating wealth. So a lot of our investors were people who had made money, or were pension funds, or were banks or institutions. And for them, the key thing, it wasn't about how much you make, it's about compounding and not losing.
Keeping it safe.
So I'm a big believer that you can compound over time and generate attractive returns if you don't make too many mistakes. You don't have to have huge home runs and massive winners, but if you can compound those small gains day in, day out, that's effectively how we built our 17-year track record in hedge funds.
Absolutely fantastic. Okay, so mindset essential, obvious, but what do you think about working on yourself? Like further education outside of the traditional, going to school, and some people going to university.
Yeah.
Is that something that people should do? Is that something you did?
Yeah. So you never stop learning. I tend to learn more. Having been through school, I never went to university. It wasn't really a choice that was made available to me at that time. So I never went to university. My kids have, and they've had a great education. I've been fortunate enough to pay for them to go for private school. So a lot of the things that perhaps I never had, I've tried to pass on to my kids, but they've also had that grounding that I had as a kid and my wife had as a kid, because we both grew up from humble beginnings. So I guess it's that mindset comes from there. So I'm always learning by observing. I learn by meeting people, listening to what they say, by reading, by going to events. And if I learn something new every day, then that's great. But a lot of learning is by seeing not what to do. So I learned about investing by watching other people make mistakes that they could have avoided if they'd just worked harder, or put more thought into it, or weren't as impetuous. I'm a big believer in making decisions based on evidence and information, not gut.
Okay. So it's come up twice now that you've said that, you were learning from what not to do from other people's mistakes, and that's as valuable as knowing what to do.
Yeah, I think if I look back over my career, I could probably identify 10 people throughout my 35-year career that were sort of influential at one point. And in some of them I learned what to do, and I took that. And from some of the same people I learned what not to do, and I didn't take that. So I guess my style of investing over the years has come from my background, what I've learned at the places I've worked, the people I've met, and I've taken the things that I believe in and like, and I've ignored the things that I don't, and tried to build my own way of investing, my own discipline, my own style. But that's come over a long period of time.
Yeah, I love the fact that you believe in what you do, and then you go for it. Even though for 3 years, you probably did get some money, but not the big money. But you stuck it out, and then kind of the dam breaks after a while, and then you got the money. I want to come back to your kids, because you at 8 years old were out there earning money if you wanted money. And you said that university wasn't something that was a choice that was afforded to you. But then your kids, and the reason I'm going to ask this question is because I know a millionaire who said that the best thing that ever happened to him was when his dad booted him out at 17 years old because he had to land on his feet. But now all his children still live with him. And I said, but I thought you said that was the best thing that ever happened to you. Don't you want that to? He goes, no, but I love them too much, etc. Yeah. So did you force your children to work at 8 years old? Did you?
No. So I think you're things that you never had. I think it's natural for anyone. Things that you never had when you were younger, like foreign holidays and regular overseas travel. Yeah. You kind of then spoil your kids a little bit. But we were also quite strict with our kids as well. So when I look at both of my kids now, they're both independent financially. They never ever ask me for any money. Even if I say to them, do you need any money? They say, no, Dad, we're fine. So in a sense, they've had a lot of the things that I never had. But, interestingly, my son sat down and listened to me and my friends talking about stories from school days, and has often said, I wish I had the childhood that you had, in some respects because we had freedom. We didn't have the same pressures that kids have today. It's just a different society. So my kids are very grounded, very level-headed. They work for themselves. Whatever they've got, they've done it off their own back, not off of my wife and I. Yeah. So, but they still live at home.
Yeah, and that's based in London.
In Sidcup in Kent. Yeah, just outside London.
Okay,
yeah.
All right. So you have a Scottish accent. I'm assuming they don't.
They don't. No, they're. My wife's English, so my kids have an English accent as well.
Oh, fantastic. Okay, I want to ask you about investing money. Can anyone do this? Do you think, or is it really reserved for Wall Street and the I'm going to say boys, although nowadays it's not, but the City of London?
I think anyone can do it if they stick to what they know. So I was once asked by a young footballer who liked investing, what should I invest in? I said, stick to what you know. If you're in the changing rooms, figure out what boots are people wearing, where does the kit come from, what shin pads do you wear, who makes them, who's the manufacturer. Stick to what you know and what you understand and learn. And if you're going to try investing, stick to what you know and try small. And learn as you go. There's no reason to jump in. You can easily today, there's no reason why you can't just buy a handful of shares in a few different companies. But the most important thing, and again, I recommend anyone should read Warren Buffett's books, it's really about sticking to what you know within your circle of competence and learn and understand as you go. So I think anyone can do it. And there have been very many successful investors who just started out on their own and learned as they went. I think there's a tendency if you have surrounded by too much noise, lots of trading screens, reading all the newspapers. If there's information overload today that we never had 30 years ago. It's almost too much information. You almost need to cut the noise out and just focus on things you understand and see in your everyday life.
Yeah, for sure. I think several generations ago they didn't have enough information, and now we have too much information. You're absolutely right. One of our most successful graduates, Rob, he took 350,000 and turned it into 1.1 million, and then for his kids 75,000 into 340,000, and he did that in 3 years because, and a lot of people don't know this, he's from the pharmaceutical industry. So he really looked at the pharmaceutical industry and made that his kind of playground. Yeah. And he every day was studying. So yeah.
Yeah, and for example, that's a sector that we avoided. So when you have biotechnology and drug trials,
biotechnology,
and you have binary outcomes, that's something we never understood. So interestingly, we avoided that. In the 2000s, when you had the dot-com crash, we were shorting tech because all this stuff looked crazy and overvalued. So I've never been a massive tech investor, yet here I am today, I run my own tech business. So it's very different what you maybe would buy in the market versus how you run your own business. And I think today the tech world is very different to what it was back in the sort of dot-com bubble.
Absolutely, and the valuations are crazy. It's interesting what you said about you were shorting, because there was a time when, you know, the government was like, you know, it's the shorters' fault, and it's like, really? And they wanted to ban shorting. In fact, they might have done for about 3 months.
There was periods of time where from time to time shorting was banned when markets were volatile. I guess I've known lots of famous short sellers over my time and hedge funds, and the analogy I guess I would give is short selling never killed a good company. No. It's bad management that kill companies. So typically short selling are just guys betting against a bad company. Yeah. So I see it as no different to being long or investing in a good company. It's just the opposite. Yeah. And most really bad companies that are shorted, they're shorted for a reason. And one thing I'd say about anyone that about going long and short, if you go long a stock, you can only lose 100% because it can only go to zero. However, if you short a stock, you have infinite losses because it can keep going up and up and up and up.
You better have that stop loss in place.
So number one, you need a stop loss, but as a short seller, you need very high conviction, and you need to have real evidence that that company it has problems and is going to go down. Otherwise, you have infinite losses. So short selling is not for the faint-hearted, and it's not something you do on a whim. You really have to have real conviction that there's a fundamental flaw or a problem within that business.
What's the most that you've ever lost on a trade?
So we never really thought about trades as trade by trade. All I can tell you is the feeling in 2008, having built this business at BNY Mellon from pretty much 0 to 2 billion, all of our own capitals in there, the team.
Well, that's interesting. Tell us about that very quickly. So you put your own money in as well?
Everything I ever invest in, it's my own money goes in. So I'm a believer that if I don't have conviction, why should anyone else? If you don't have your own money in there, then you may be inclined to take risks that you wouldn't ordinarily. So a lot of fund managers may be willing to take risks on somebody else's money that they wouldn't do themselves. Mm-hmm. So who wants a fund manager that says, oh yeah, come into my technology fund and we'll do well, and you ask them, what are you doing with your money? And they say, oh yeah, it's in government bonds. So it's not really that going to be that convincing or reassuring. So my view has always been, I can't say with conviction to someone, you should invest in our fund if it's not alongside my own capital.
But okay, so and we'll come back to that feeling they had in 2008 in just a moment. But so do you think that the city kind of does things to us that maybe it doesn't do itself? I mean, they're making a lot of money. Are they always got our best interest at heart?
Well, I think you've had changes post 2008 actually, where some of the banks and fund managers that I know are now creating more like deferred bonus schemes, or if you get a bonus, a percentage of that you get now, but the rest of it may have to be deferred or go into options. And actually, if you look at one of my mates is a trader at a large investment bank, they're kind of, when you're that senior, you're almost on the hook for previous trading losses that could go back as far as 10 years. So I think there's been an adjustment in the alignment where you could effectively go for it with other people's money. And that's one of the criticisms of hedge funds, is once you get beyond a certain size, the management fee becomes more important than the incentive fee or the performance fee. There's a tendency to asset gather and just live off the management fees because it's recurring revenue, as opposed to the performance fee, which is a percentage of profits.
For sure.
So I think there's been some adjustment and some realignment there. I would say, though, that perhaps that's now spilled over to the venture capital industry, where they're not necessarily putting their own capital into the business, they're allocating other people's capital and have a share in the upside. But I think for the traditional banks and fund management houses, they've pretty much put mechanisms in there that kind of align interests a bit more.
Okay, so coming back to the feeling that you had in 2008, where this business that you've built up, and now 2008 happens, everyone's panicking. How did you feel?
Yeah, well, I guess having been an investor in stocks personally since I was about 16, since 1984, I'd never experienced losing money before. So 2008, I'd experienced volatility, I'd experienced macroeconomic shocks, but I'd always been quite fortunate to either get out or to be hedged or to have had a different view at the time. So having never lost money, to then have your first kind of big losses when you've got your assets to a peak of 2 billion, I guess it was a bit of a shock. Number one was that kind of gut instinct you get when something happens, a bit like when you're going down a roller coaster and your stomach drops. I've probably had that 2 or 3 times in my life. that happened. And also all my own money's aligned, so we went down something like 20%, so 20% of 2 billion is 400 million. Didn't all happen in one day, but over a period of days. And at that time the stock market went down almost 50% from memory. So there was that feeling like not only am I losing clients' money, I'm losing my own money, and I've spent years building this up. And then after half an hour, there was that sort of instinct that came in, like almost that I'd learned in Clydebank, like, actually, look at the price of this stuff. This could be the best opportunity I've ever seen in my life.
Okay.
And therefore, quite quickly, it was like, okay, if we liked that at 100 and it's now at 50, we probably love it at 50. But what you had then is you had this liquidity crisis where everyone was selling and you had problems with the banks, and there was no stability and there was kind of no floor at that point. So really, had you jumped in early, you would have lost more money and more money and more money on the way down. So I guess there was a period of about 6 months where we were tracking this very actively, and there came a stabilization point, probably like within 4 to 6 months, where we felt it was appropriate to start buying again, because we also did have cash available.
I was going to ask you, so you're not fully invested at any one time?
Well, no, so pre the crash in 2008, we were struggling in that part of the year to find what we call value in many of the strategies. And that's what happens when you have too much liquidity and everything's trading at a premium or at fair value. We're value investors at heart. We couldn't find value. We're like, this is crazy. Everywhere we go, we're not seeing value. So before the collapse had happened, we'd actually put in a sell notification for about 30% to turn that into cash. And we also had cash. So we were probably moving towards becoming the most defensive we'd ever been. But where you're a fund of hedge funds and you have things like quarterly liquidity or monthly liquidity, we put all these notices in, but then the collapse came during the period that we put the notices in, so it meant that we didn't get all the liquidity back.
Okay.
So we were actually very defensive at that point, that we lost a lot of money. We'd been building our short exposure, moving to more senior secured bonds, shorting subordinated debt. We were doing everything that we felt was kind of classic things that you would do to protect your downside. But what we hadn't figured out is how much leverage was in the system from other players. We weren't leveraged, but we didn't know that everybody else was. Okay. So a lot of this asset inflation and liquidity was coming from leverage. And when that leverage unwound, that's why the banks had such a problem, because they were the ones that extended the leverage.
Yeah, for sure.
So it really took a while for the leverage to unwind and play out, the selling to play out. And what's also very interesting is that things that we would call safe and secure went down more than stuff that wasn't, because you could sell that. There was liquidity. So in a liquidity-driven market, you sell whatever people were selling whatever they can to meet their margin calls with their brokers. Yeah. The stuff that's illiquid, that's lower quality, you can't sell that, so there's nothing you can do. So you had this ironic situation where the higher quality stuff was actually falling faster because it was liquid than the poor quality stuff.
So did you get in? Did you manage to get something once it had started stabilizing?
Once it's stabilized, so we did two things. We ended up in a situation where some of our investors wanted to get out, and some wanted to stay. So that idea of this is the great investment opportunity, but some people had liquidity problems elsewhere, and therefore we'd say, look, we're down 20%. They say, yeah, you're doing better than everyone else. Everyone else is down 50, so we're coming to you to get our money back. So we became a bit of a liquidity vehicle. So at that point, we approached the regulator, the Irish Stock Exchange, and said, look, we're now managing this 2 billion fund, or pot of capital, and we have sets of investors that now have two different objectives. They're not aligned. So what we'd like to do is offer them all the opportunity to either be in the stay fund or the go fund. When they decided, we split the fund, let's call it equally in two. So the people who wanted to go, we sold their assets as quickly as we could. And it took them 1 year to get all the capital back, and they made a profit during that period of, let's say, 1%. The investors who stayed, 12 months later, they'd recovered their losses from the prior year, like almost like 20 odd %. And they actually ended up getting, if they wanted to sell, they could sell and get all the liquidity. So what that taught me was, the real lesson there is, it was all about investor behavior. If you've got the same pool of assets, you divide it in two, half want to leave, half want to stay. 1 year later, they're up 1%, they're up 20 odd. That's just about individual behavior.
Fantastic. Okay, so we've spoken about your experience, we've spoken about mindset and the importance of it and continuous learning and educating yourself. But one thing I'd love to ask you is a series of words, and let's just see whatever comes out, okay? So for you, Derek, what is money?
Money is an object that you use to buy things.
Okay. I'm going to come up with another word, whatever comes out. So wealth.
So wealth to me is aligned with health. So for me, wealth is how I feel, how my family are, how my friends are. It's not how big's my car, how big's my house. So wealth to me is more about how I feel and the people around me that are important to me. So it's really wealth. It's about how you are, not about how much money you have.
Okay, and final one, excess.
Excess to me is buying 10 cars when you can only drive one, unless it's an investment strategy. Excess for me is having a 20-bedroom house when there's only 2 of you. Yeah, so I'm a big believer. I come from humble beginnings. I only ever consume what I need. My needs are quite limited, so what I need today is not that much different to what I needed when I was 16. In fact, I just upgraded my car, having had the same car for 19 years. So to me,
you are like Warren Buffett. He was, he's the same, right?
Well, I guess I don't need any more than one house. Yeah. I'm not saying there's anything wrong with having 10 houses or if someone's a property investor, but me as a person, everyone's needs are different. So all these words mean different things to different people.
Of course they do.
To me, they're about basics. I'm more interested in the human need. What do you need to survive? Because I've been there. And what do you need to have a comfortable lifestyle? But importantly, how do you treat everyone along the way?
Well, interesting you should say that. And you just also said that, everybody has a different definition of the same word. So some people might say, well, excess is me having more than I need, and therefore I have some to help other people, for example, and treating them well along the way.
Yeah.
Yeah. Okay, so 2 more things and then we'll wrap up. Now, I ask this question to everyone we interview. What do you think is the one thing that stops people becoming wealthy, and what can they do to change that?
Laziness.
Really?
Yeah, because if you work hard, you've seen many people come from humble beginnings. I once, if you look at the rich list of the richest people in the world, if you take out the tech companies, most of these people are in their 80s and 90s, and many of them are immigrants. So they've worked hard, come from humble beginnings, and worked hard all of their life. They've never stopped. They were probably millionaires or billionaires in their 40s, but they're still working into the 90s. So I kind of think there's a mindset of being lazy. If you're not lazy, you can achieve anything if you apply your mind to it.
Okay, so having a good work
ethic is critical.
But what if you don't have a work ethic? Because I'm not making excuses for these people, but let's just say
go get one then.
You're an immigrant. Yeah, but absolutely. But how do you get one? So, for example, if you're an immigrant and you're like you were when you were 8 years old, right? So, well, if I want something, I'm going to have to go and get it. What if somebody grows up and they've got everything? It's just like, well, it just comes to me.
Well, nobody's got everything.
Mm-hmm.
So again, there are many people that think they've got everything, and it turns out that actually when they look back, they haven't got any friends. Or my friends are the same people I went to school with. I've got many friends along the way, but they're the same people I've known since I was 4, 5, 10, 12. So it depends. Again, I would never be critical of anybody for wanting more cars, more boats, more houses, more wealth. Everyone's different.
Yeah.
But I think there'll be a lot of very wealthy, lonely people.
Yeah.
Right, who are used to getting everything their own way, and it turns out when they look back, they've not really acquired what I'd call friendships, community, and those things to me that are, if you take that part away from me, having money and none of the other things is kind of an empty, meaningless, pointless exercise.
Agreed. If they weren't fortunate enough, though, to have your upbringing where you had to, at 8 years old, start fending for yourself, and then you just got that work ethic, what if they just don't have that? Is there anything that you say get it, but how do they get it?
The other thing I say to people is, again, anyone I talk to about jobs, coming and working for us, getting a job, you have to find something, find your passion, find something that motivates you, because if you find the passion, you'll find the work ethic. It will come. If you love something that much, whether it be sport, music, investing, whatever it might be, if you have the passion, you'll find the work ethic.
Yeah, so focus on that. And so we often discuss, obviously knowing what you want, but also why you want it, and the why being the motivation, the kind of the purpose behind it.
Yeah.
Do you have any thoughts about that? Like, what's your why?
Yeah, so I kind of put something on LinkedIn a while ago, and I kind of had three. So number one is I need to make money to look after my family and my mom and my relatives. So one why is generating sufficient income to look after your family and your friends. Okay. The other why is the competitive instinct that says, I want to beat someone,
okay,
at whatever it might be. So I hate losing. Mm-hmm. I'm a bad loser. I'd like to think as I got older I'm a good loser, but I like to win. And I like to beat someone. So if someone says to me, you can't do that, then my mindset is I'm going to do it, and I'm going to keep going until I show you that it can be done. So I think having that sort of, and I don't like the word necessarily winning mentality, but that resilience to keep going in the face of everyone saying, no, you can't do this. If I've done the work and I've done the research and I believe I can achieve it, 100 people tell me I can't, it's just going to make me more determined. Okay. But I think the third one for me, the why, is there needs to be something else for me. There needs to be, I get my pleasure and satisfaction, not out of making money. I might have some inner satisfaction, but I get real pleasure off of helping other people, whether it's helping them get a job, whether it's, I spent yesterday morning at a breakfast meeting about helping youth homelessness, helping young people who've had a difficult background to get a job. That's a why. Helping young kids that have come from a broken home, helping them to get what they need in the future is a why. I'm going to do my third Kilimanjaro trek next year to help a Tanzanian street kids home that I helped 10 years ago. Those are my whys. Like, they motivate me to make money. If I make money, I can then give that back.
That's brilliant, because it would have to be something huge to get me back up Mount Kilimanjaro, because that was disgusting. That was one of the toughest things.
Well, I did it twice, 1 year and then the following year.
Okay.
And when I told someone, they asked, did you drop your wallet the first time being a Scotsman? So.
What do you think about the school system? Because you talked about winning. And nowadays I think that there's this thing about, don't worry about winning, so they don't give number one. It's like, as long as you participate. What do you think about that?
Well, it's a different era, different environment. I grew up where it was all about, I want to be first in the maths class or the English class, and I think every kid needs a level of competition. So I think rather than taking competition out, I think it's more about finding the right levels of competition where everyone feels that they've got a chance of winning or they're part of the winning. Rather than saying, okay, you've got this person that gets 100% maths all the time and this person that gets 10%, well, you shouldn't demotivate the one who's focused, but you should then try and find everyone's got a talent, try and find out what that talent or that passion is, because everybody's good at something. But I think sometimes the school system doesn't allow for that, doesn't really enable people to pursue those passions, and quite often is dismissive. So even if I take my own son as an example, they would often say, yeah, he's a little bit slow, he's not very good at this, not very good at that. He just about passed his 11 plus, went on and got all of his A-levels, went on and got an honours degree at a good university. But if it wasn't for my wife to keep working with them and keep helping, he may not have achieved that. So I think the school system can often be dismissive. You need people to be competitive.
Yeah, absolutely. Okay, bonus question. Obviously you're a man that understands investing in the stock market. I'm invested in cryptocurrencies. So being a financially successful man yourself, what do you think? I think we've already spoken about the stock market.
Yeah.
Do you think anyone can do that? But what about cryptos? What's your view on
So a few people have asked me along the way at various events where it was very topical, particularly over the last couple of years, what do you think of crypto? The answer is I don't. I have no need to think about it. It doesn't affect how I look after my customers, how I run my life. However, same with blockchain. People would ask me, what do you think of blockchain? To me, blockchain is just a distributed ledger. It's a large database that allows you to do something a different way. So those in themselves, to me, don't necessarily solve fundamental problems. But I think for every new technology that emerges, you always get periods of initially you get speculation, but what comes out of that is often very good user cases. So I could think of very good user cases where blockchain's an appropriate technology to apply, but it's not in itself a solution to everything. And the same with crypto. So if in my business I have no real need for it, but I could see potentially if I'm providing my customers, cab drivers, market traders, and other small businesses, I could see a logic where if I'm providing you with rewards and incentives linked back to us doing business together, where I could use a virtual currency that could be interchangeable within my customer base. So that's a logical reason where I could reward them with that as opposed to physical cash. But in my business, I don't really see a lot of need for it. I don't think about it too much because it's just not really a user case. And coming back to what I said at the start, if you don't have that knowledge or user case or rationale for why you're doing it, then I really don't spend any time thinking about it.
Yeah. Or, I mean, I used to say no to cryptos, and if somebody came up to me and said, well, what about these digital currencies? No, do what I'm teaching you. What about Bitcoin? No, do what I'm teaching you. And then somebody said, why? Why no? And I was like, I don't know. I haven't done the research. So I did then the research.
Yeah.
And it's what you said before. You said, if you don't know about something, then do the work, do the research.
Yeah, my son said to me a few years ago, actually, Dad, what do you think of crypto? We should be buying crypto. A lot of people have made a lot of money off of that.
When did he say that? Can you remember?
It was probably about 3 years ago when he was 18. And I said, son, my ethical, I don't really understand that. He said, yeah, but it keeps going up. It's like, why does it keep going up? And what happens when it doesn't keep going up and people want to get out? So I'm an investor as opposed to trader. I think if you're a trader, there's lots of asset classes, instruments that people can successfully trade based on whether it be short-term signals or momentum. I'm not a momentum investor. I'm not a trader. I'm a long-term investor. Yeah. And everything I do typically needs to go through a cycle or takes time. Yeah. I just don't know what it's worth or what the value is. And therefore, I'd be operating in a pool with lots of people that have got more or as much information as me, and therefore I have no competitive advantage. I need to find an advantage in everything I do, and if I can't find it, then I'd rather stay away.
Brilliant. Derek, thank you very much.
No, thank you. Thank you, Marcus. Pleasure.